Welcome to part 2 of retirement plans for the small business. I'm Glenn Downing, certified financial planner professional at Cameron Downing, a registered investment advisory firm here in Miami, Florida. Part 1 was about the SEP IRA, or the Simplified Employee Pension. In this video, I'm covering the SIMPLE. The SIMPLE IRA is the Savings Incentive Match Plan for employees. Unlike the SEP, the SIMPLE allows for both employer contributions as well as employee deferrals. The plan is ideal for employers who want to contribute something, but not a lot, to employee retirement accounts. The SIMPLE is therefore driven by employee deferrals. Who is covered under the SIMPLE? It works for an employer with fewer than 100 employees. The employer cannot have any other type of retirement plan, only the SIMPLE. Any employee who earned $5,000 in any of the previous 2 years and expects to do so in the current year is eligible to participate. The plan must be established before October 1st for the current year. After October 1st, it will become effective for the following year. A big part of retirement plan design has to do with discrimination. The IRS wants to be sure that the plan does not discriminate, meaning that the plan's benefits are available equitably across the board to all employees, both to management and to the rank and file. 2 safe harbors exist for the employer to make non-discriminatory contributions: the 2% rule and the 3% rule. An employer can choose which to use. The 2% rule means that the employer contributes up to 2% of payroll to all eligible employees. This is subject to a $285,000 salary cap in 2020, so the maximum 2% contribution will be $5,700. Under the 3% rule, the employer makes a 3% of payroll matching contribution only to those employees who choose to defer into the plan, again up to the $285,000 salary cap. So if employee A deferred 3% of his earnings, the employer must match with an equal amount, capped out at $85.50. As I mentioned, the SIMPLE plan is driven by employee deferrals. The maximum employee deferral allowed is $13,500 in 2020. Those over age 50 can defer an additional $3,000. As you'll note, these are much lower maximums than in qualified plans. All contributions vest immediately. There's one unique feature to the SIMPLE though. Any transfers, distributions, or rollovers made during the first 2 years incur a 25% tax penalty, not the usual 10% penalty before age 59 and a half. The clock starts running when the first deposit hits the account. If you participate in a SIMPLE, you may still be eligible to do your own traditional or Roth IRA. Deductibility of the traditional IRA depends upon income limits and coverage under other qualified plans. Roth participation depends on income limits. The SIMPLE then, as I see it, is a good way for an employer to give something to his employees and to give them an opportunity to defer on a tax advantage basis. From the employee's point of view, this is, air quotes, free money, a benefit that the employer chooses to give over and above salary. Each participant has his or her own SIMPLE IRA and makes his or her own investment choices. Upon separation from service, the SIMPLE balance, after 2 years, can be rolled into a personal IRA or to another qualified plan with a new employer. Have any questions for me? Well, feel free to email or get in touch. info@cameron-downing.com. Follow us on LinkedIn, Facebook, Instagram, and YouTube for more personal financial information that is relevant to you. Once again, this has been Glenn Downing, Certified Financial Planner Professional at Cameron Downing. Thanks for visiting.